let's go ahead and hop right into it. We've talked about this chart in the past. This is going to be the summary survey or the summary table of all of the ISM data. As you can see up in the top, the ISM data came in for the United States at 59.5, so a little softer than prior month at 60.6. China actually missed expectations by a little bit, came in at 50.3. Expectations were a small bit higher than that, down from 51.3. So China's starting to teeter back in that territory of being flattish type growth, which I think is something we want to keep an eye on. But that being said, the table down below is specifically looking at North America. And, obviously from a summary perspective, you get a 59.5. That's a strong data point. You look at the very bottom on the summary of the overall economy. Economy is still growing from a manufacturing standpoint, albeit at a slightly slower rate. So there are some who are kind of questioning, have we seen peak growth? Have we seen the best that we're going to see? There's a possibility for that. But nonetheless, growth is still growth, even if it's a slower growth rate. A couple of the items I want to point out here within this table that we talked about in months past. The first one is going to be the unemployment picture, or what they call the employment picture, which is really kind of teetering on either side of 50, which, we come in one month, it'll be above 50. Then we get a new data point and all of a sudden it misses expectations. Employment's kind of a tricky one right now that I think we need to be really cognizant of, because I think we're still in an environment right now, particularly given the spread of the Delta variant, that there are a lot of questions on this return to work, this return to normalcy from an employment standpoint. And I think it's coming in fits and starts. And that's really kind of delaying a lot of these elements of the recovery and getting back to normal, and maybe even ultimately getting prices back to normal and supply conditions back to normal. So employment's going to be a big one. Obviously on the inventory side, whether we're looking at wholesale inventories or customer inventories, they're still very lean. I don't think that's going to be any secret to anybody here within Ryerson or any of our customers. Inventories are fairly tight. We'll talk about that in more detail on a product level. And then lastly, while prices have come down a little bit on a month-over-month basis from 92.1 down to 85.7, keep in mind, anything over 50 is growth. 85.7, even though it's lower than the prior month, prices are still screaming in most aspects. And we'll kind of get back on this theme of the shortage of almost everything and what's changed on a month-over-month basis or maybe quarter-over-quarter basis. But generally speaking, manufacturing economy in the U.S. looks quite good at the moment. This gives a quick picture within the metals landscape. So this is the Bloomberg Industrial Metals Index. We were kind of chopping down a little bit and moving a bit lower on the Industrial Metals Index over the last couple months. We have very recently revisited those 5-year highs, kind of bumped into it and then pulled back down. So it sort of retested that thus far. I mean, if you're looking at like technical analysis, some might say we just hit a double peak and that who knows where we go from here. But a technical analyst might say you actually start to head lower from here. But that being said, retesting of the highs in the last week, markets are still strong here within North America. The U.S. very much so seems to be in the driver's seat with regards to the strength in the global economy. There are some things we'll talk about that we're seeing, most particularly within the Asian markets and China, where there's a little bit of squishiness going on. And I think there's a question mark on if and when China maybe rears its ugly head and starts to impact markets a little bit. But that'll remain to be seen here in the coming weeks and months ahead. So I always try and introduce a new topic or a new chart or series of charts. And this is one series of charts that, as I was going through and preparing all the slides, I came across, and it actually kind of surprised me, because what this is the U.S. flatbed truck demand index, and this is compiled by truckstop.com. And what it's intended to do is give a gauge of how many available flatbed trucks are there for each available or demanded load on the demand side. And ultimately, if things are very, very tight, there's going to be more demand for trucks than there are availability of trucks. And you can see just in the last 12 months, we've seen this index shoot higher. And I was questioning on whether or not I was going to include this chart or some of these charts here in the coming slides. And then I listened into Ryerson's quarterly conference call today, and one of our individuals in charge of logistics actually mentioned this notion that, hey, we're actually starting to see an alleviation in the trucking market here within North America. So I was like, look at that. We got ahead of it. We're providing this slide within Cup of Joe. So this is very fresh. It is something that we are seeing within Ryerson, probably seeing across the industry. But what's interesting about it is it's both on a demand basis. So the backlog of flatbed trucks is beginning to abate, and also flatbed rate. So the rate to actually get a flatbed truck is also starting to turn over. And what caught me by surprise was, as I was making these slides, I had this one in just after that base metals, the industrial metals chart. And what kind of blew my mind was how well correlated the trucking index is on a rate per mile to the industrial metals index. So I've literally just overlaid them in the same 5-year chart here. I'm not here to say that because the flatbed rate is rolling over that necessarily metals prices are going to come down. But if we were to take a step back and say, could there be a relationship between the two? I think it would make a lot of fundamental sense. You could say, if logistical networks start to normalize, if backlogs of flatbed trucks begin to become more available, then the free flow of goods and services becomes easier to get and prices can come down. Supply starts to normalize. So that's a little bit of a potential Dr. Doom, and I'm not here to suggest that we're going to see a collapse in either of these indices, but it is a very interesting correlation, and I had never come across this relationship before, but I think it's a pretty compelling one, and obviously just as you look at it visually, there appears to be a pretty strong relationship between the two indices. Now, counteracting the Dr. Doom narrative, this is the international scene. This is more of what the international picture looks like. And I think that some of this is related to just the continual spread of COVID, the continual spread of lockdowns. It's just causing the international markets and the ability to get a container to be very difficult and very expensive. This is a composite freight index to get a 40-foot metal container. These are the types of metal containers that go on the large vessels that move product around the world. And you can see that it's just gone parabolic. We talked about this a little bit last month. I think last month we talked specifically about the rate to get it from China to LA. This is more of a composite index, but generally speaking, two are very well correlated, and they're showing no signs of stopping. So kind of counteracting what I showed on the flatbed side, which suggests that the North American market from a logistical standpoint is actually freeing up a little bit. The international stage is not yet, unfortunately. So as we're thinking about imports, as we're thinking about the flow of, maybe cheap goods from the Asian economy coming to the United States, those things are probably going to see price increases because the cost of moving it around is moving up 5 to 10-fold in just a matter of months. So pretty staggering stuff on the international side of things.
Hey, Nick, got a quick question from an audience member here. We've heard that for every truck driver in the US, there's about 100 loads available. Do we know if that's true or not?
I don't know if that specific metric is true, and I don't want to talk too specifically about Ryerson's internal things because they aren't public. But I will say that I had a conversation with one of our individuals who does focus on the logistics of Ryerson's goods, and I will say that her commentary corroborated fairly well with this chart, which was that 3 months ago, when we looked at the backlogs of flatbed trucks and compare it to where we are now, there has been a fairly dramatic improvement in there. There was still a suggestion of backlogs, but the number of backlogs has come down dramatically. So I hope that's okay that I talk anecdotally, because I just want to be careful about not giving too much insider information, if you will. But I think that gives a general sense that's corroborated by the data that truckstop.com is seeing.
I think you make an important point here, lining them all up, right? Because the international, even though metal prices are up, international's up, freight's down. So whether you thought, maybe getting it in from overseas and shipping it around the country might lower because of the flatbed rates are down, international is still high. So that price is still on the table.
Exactly. That's exactly right. And then lastly, again, I apologize for putting my Dr. Doom hat on, but it's an important chart and one that a lot of analysts and a lot of traders do watch. And we've touched on at least one element of this chart in the past, which is the Chinese credit impulse. We've been talking about it for a number of months now, that China does appear to be, very much so based on this blue line, in a cycle of credit tightening. So what does that mean? They are they're tightening lending conditions, reducing credit card applications, trying to rein in risk taking, trying to rein in property markets. And you can see that visually here within this chart. And it's tending to repeat the two prior cycles that we had seen. Just visually looking at these charts, it appears to be playing out that way. Now, what I've done here in this chart is I've overlaid on a 12-month lag the Bloomberg Commodities Index. So the Bloomberg Commodities Index is looking at all things across commodities, crude oil, natural gas, grains, metals. And when you overlay the two, there does appear to be at least some relationship. And I'm not here to say that I'm predicting the future. I'm just saying that a lot of analysts do watch this chart because it does appear as though there's at least some semblance of a connection between the two markets. And it makes sense. If China is trying to slow down their economy or rein in risk taking or rein in lending to their economy, ultimately that would reduce building and the electric grid and just general spending in total. And that would eventually feed through to less demand for metal products or things that have metal in them. So it makes sense that there would be kind of this lag effect to the ultimate price of commodities. Now, as we look at this blue line or the blue data, where did that peak out? So as we think about this, it's got a 12-month, typically a 12-month relationship to the price of the Bloomberg Commodities Index. That index in the blue line peaked out last year in October before it started to tighten up. So if we were trying to say that this chart is going to reign true and that this relationship is going to play out again, in October of 2021, given the 12-month lag, would be roughly when that could happen. Now, again, I'm not trying to make predictions. It may be different this time. There's a chance that China's kind of taken a back seat to North America's strength. And now North America is just driving the global ship. I don't know, but it's at least something to be cognizant of. Hopping into each one of the metals individually, we'll first talk about carbon. Unfortunately, I'm going to sound a little bit like a broken record the prior months, which is it's onward and upward. This is actually a pretty staggering chart because as we look at it 12 months ago in August of last year was when steel prices hit their lows. It was the low point of the cycle for COVID, and prices got down to $440 on the CRU. You can see that looking at this chart, so too was Chinese prices, and so too were European prices. So we all kind of started off on the same wavelength back in August of last year. Well, we went fairly different trajectories. We all generally went higher, but to the extent to which U.S. prices has exceeded China and Europe is by magnitude of at least 2 in the case of China and by at least 30 or 40% in the case of Europe. So there's no doubt about it. The United States has been extra accommodative to the economy here. We've generally had higher vaccination rates, a better, stronger return to normalcy here. And I think that's reflected in a lot of these markets. Now, which way do the mean reversions play out? Do we eventually revert back down to their levels? Do they catch up to our levels? Time will tell. But there is certainly a divergence here that is far in excess of anything we've ever seen in the history of the steel markets, at least as long as the indices have been in existence. A little bit of good news though, as we look at the production data, we've looked at this in the past on a percentage basis, capacity utilization. Here we're looking at it just on a strictly tons basis. So how many tons are the mills producing on a weekly basis? And a bit of good news here, we are finally seeing US steel mills producing the type of tonnage we saw back in pre-COVID levels. A bit of good news and then a little bit of bad news. I do question whether or not getting back to pre-COVID production levels is actually enough, because here we are in an environment right now where US construction markets are running really hot. Manufacturing economy, as we talked about, it's running at 59.5. There's real strength here going on in this market, not just based to pre-COVID, but based to any time period. So there is a question mark on, is getting back to pre-COVID even enough from a supply standpoint? I would make the argument, or I could make the argument, that because of the growth we're seeing in the ISM data, we might need to see a little more before it fully normalizes, because there is real growth going on within the demand side of the picture. So imports can help with that. Obviously further domestic production and ramp ups from other mills can help with that. But we're still kind of in this rebalancing phase where now that we're catching up, backlogs are coming in a little bit. And we talked about it, the freight market is starting to improve a little bit. I think we're in the early stages, or it seems like we may be in the early stages of things normalizing a bit.
Hey, Nick, that's a really important point, right? Because we talk so much about getting back to pre-COVID, which obviously very important. But when we were pre-COVID levels, particularly on utilization, were those considered strong enough to meet demand? In your opinion, I guess it speaks to your question, do we need to go higher?
Yeah, I think if we're talking about pre-COVID relative to now, I do think that certain industries are certainly seeing growth rates that are positive relative to 2019 levels. Did we have enough supply back in 2019? Yeah, we did. But one big thing that changed between 2019 and now, well, I guess it's all related, but it's a couple things. There's been a lot of consolidation in the steel industry here within North America, a lot of acquisitions. So we did have, call it 6 to 8 mills who were producing steel back a couple of years ago. That's now down to basically four or five major players. So there has been a consolidation in that space. There's also been a lot of idolization on a permanent basis of assets. So in other words, mills like Cliffs Natural Resources taking assets that were temporarily offline and making them permanently offline. Those are game-changing type moves. Now, we can tease through all that by simply looking at this chart, which is how many tons are going into the market. That's kind of how we tease out all this data and say, from a tonnage standpoint, that's really all that matters. Are the tons going to meet the demand on the tonnage side? And I think we're starting to get back to a range that's helping to balance that. Now, with that said, we've looked at this chart a lot in months past, and it's been wrong every single time up to this point. It's been forecasting maybe another 30 days of upward move, and then the rollover. And here we are sitting on the futures basis, and this is looking at the futures curve a month ago, a week ago, and today being the orange line. And as we look at this orange line, it's kind of like going up to the edge of a roller coaster on that first hill, and we're wondering how big the drop-off is going to be. And that's what the futures market is basically suggesting. That's not what I'm suggesting, that's what the market's suggesting. And that's a real question mark, because right now we're seeing this interesting phenomenon whereby even though we're getting closer and closer to this lip of the roller coaster hill dropping off, we continue to see CRU move higher. So CRU, the spot index, continues to tick higher and higher and higher. It doesn't seem to care or recognize the fact that the futures market's saying something totally different. So there is a misalignment there. So either the CRU is about to see some sort of correction, either a flattening out and then a rollover, or the futures market is wrong again. One or the other has to be true. It will be very interesting to see how this plays out in the next 30 to 45 days. John Packard, who works for Steel Market Update, he put out a note yesterday and basically proposed this notion or this hypothetical of how will we know when we get to peak steel prices. And one of the things that he noted within his note was there are beginning to be more import offers on carbon sheet. And one of the things he noted specifically was a little bit of competition now amongst importers trying to compete for price, which is something that we haven't seen in a while. I will admit that is a different dynamic within the import landscape. So to put some numbers behind it, specifically, he had mentioned the fact that Turkish import prices landed in the United States maybe as low as $1,400. You compare that to where we are on the spot CRU, 1860, there's a pretty big gap there. So how are we going to close? How are we going to make sense of that gap? Well, the futures market is attempting to do that. Is the futures market going to be right? Are the imports going to bring the market down? Or is the demand picture strong enough that we continue to see spot markets move higher and prove the futures market wrong? I don't know, but it seems as though we're getting really into the crux of things. And we're also heading into a point in time, Q4, which historically is a seasonally slower type time period as mills and OEMs shut down for holiday schedules, maintenance, things like that. Historically, it's a slower time period from a demand perspective. I'm not sure if we're going to see the exact seasonality that we typically see within the steel industry. Switching over to aluminum, we talked about this last month, but I wanted to reiterate it because we're now in the midst of it. The aluminum export tax has finally gone into effect as of August 1st. It's going to go into effect until December of 2021. This is an expectation from Harbor that they said there's a possibility that Midwest premiums which again is the premium to get aluminum ingot to the Midwestern portion of the United States. They suggested that this export tax could add up to 30 cents to the premiums, which would take us all the way up to almost 58 cents. We're not quite there right now. We're actually a ways off from that. We're about 34, 35 cents. So we have added, let's call it roughly 6 or 7 cents to the futures market. Will we see more of that play out as the market remains tight and as these export taxes continue to kind of take a grip on the market, or are we going to see things level out around here? Don't know. It does look like right now the trajectory, at least given the recent spot data, continues to be the upside. The last several days, we have seen things tick higher by about a half cent a day. Sprinkled on top of that is a very recent phenomenon, which is happening at Rio Tinto. Canadian smelter, they had a strike at their facility. So it's a wage negotiation. That is going to, or is expected to, tighten up the market, at least temporarily, until they're able to come to some sort of negotiation or conclusion on that wage agreement. But that's just adding fuel to the fire on the Midwest premiums.
Hey, Nick, quick question. You might actually get into it here, but you look at that situation, how comparable is it to what, I'd say 2-3 years ago when sanctions were on? Is it a comparable situation?
Yeah, I would say it's the best comparable that I can remember in recent memory. It was a scenario whereby it was a lot of political action being taken to artificially tighten markets that maybe wouldn't have otherwise been as tight as they are. And yeah, coincidentally, back then, those were sanctions against Russian entities and Russian individuals. In this case, it's obviously Russia again playing its hand. So yeah, I think there are a lot of parallels you can make here. What's amazing is we're already, if you take the LME price of $1.15 to $1.20 and you take the Midwest premium price of 30 to 35 cents, we're already in excess from a price standpoint where we would have been in 2017. So yeah, I think there's a strong corollary, but I think, from a pricing perspective, we're even higher and tighter now than we would have been then. And unfortunately, for all of our consumers on the line right now, that export tax is expected to stay in place for another several months, whereas the sanctions actually didn't play out for all that long. We saw a really swift move higher, and then it sharply fell back down. In this case, it might be more of a slow hump. I don't know for sure, but that's at least what the futures are suggesting right now, which is we're going to see elevated premiums at least into the year end. And then maybe once that export tax rolls off, that's where we're seeing the downward slope here. Again, for any of our end user customers, anybody who considers hedging, things like that, which is something that my team handles here within Ryerson. A little bit of good news here is that, as we roll into negotiation season and contract season for 2022, the good news in all of this is the futures markets are still offering discounted pricing relative to spot, as you can see here in this market. These are the actual prices that we go out and lock in when we do hedges for our customers. And since the pricing is lower on the futures basis, we're able to quote more competitive pricing when we do hedges. So something to think about for our customers. Not really a commercial, just an FYI, if anything, not here to try and say it's a good price or a bad price, just it's lower than where the spot market is, given how tight things are. And then lastly, Harbor, which is a data subscription provider for the aluminum industry, they kind of, as we were heading into the export tax situation, they kind of said, well, we don't really think this is going to have any sort of fundamental impact on the London Metal Exchange. Just it's going to impact premiums. But they did say, by way of premiums going higher and the market kind of freaking out, LME aluminum might catch a little bit of a spooked bid, if you will, and it might panic higher for a short period of time. There's a chance we might have seen that in the last couple of weeks, because we did, as you can see, we broke out of this trading, this kind of choppy range that we have been in for a couple months, and we did break out to the upside almost right coincidentally with when that export tax went into place. So was that a little bit of just market jitters, consumer jitters, freaking out because they think that they're not going to be able to get the next pound of aluminum? It might be. And you can see we got up close to $1.20 and have since reversed back down into that range. It's looking like it's going to be fairly choppy, but time will tell. And then lastly, on the stainless side, as I look at the fundamentals of the market, supply demand conditions, nickel still looks like one to me that is fairly well supplied. It's mostly in balance. Stainless, however, is extremely tight. So there is a little bit of a disconnect there. I do think that some of the buying that's taken place in nickel over the last several months has just been in conjunction with the strength that we're seeing in the stainless markets. But if we break it down just to the commodity of nickel, I think it looks like a fairly well supplied market. We did get up close to $9 per pound, and you can see pull back a bit since then. When it got up to $9 a pound, kind of coinciding with that, there was, again, up in Canada, another strike. Those Canadians love their strikes. We talked about it last month. We said blame Canada. It turns out it's turning more and more true. Canada actually had a strike at one of its nickel mines. So it's Vale, which is the world's biggest nickel miner. They did get a resolution to that strike earlier in this week. And when that became resolved, price of nickel did actually revert a bit lower. So again, it bumped in the $9 mark. It's seen a lot of strength, kind of in sympathy with a lot of the other base metals markets. But again, taking a step back and just looking at nickel fundamentals, it looks like a fairly well supplied market. If you're talking about stainless, very long lead times, extremely tight. We're on allocation. So kind of two different stories going on within that world. This chart looks really boring, but I promise you behind the scenes, it's not. This is the price of South African chrome, and it mostly looks like it's being orderly and not showing a whole lot of volatility for the balance of this year. Behind the scenes, I don't know how many of you saw the headlines, but South Africa has had some fairly intense riots and geopolitical issues. I'm not an expert on the space, but as I understand it, they put one of their ex-presidents in prison. There were a lot of riots. Those riots actually, for a very short period of time, did put at risk force majeure type issues, not just for chrome, but also for some aluminum products, some stainless products. So again, even though the index here, as we're looking at it on this chart, looks extremely stable, there have been some rumors and some talk of force majeure. Obviously, if those things were to take place, we'd see a spike up in prices because South Africa is the predominant supplier of chrome to the global economy. So something to keep an eye on. It looks like, for the most part, the geopolitical tensions and the riots have calmed down, the fires have calmed down, and a lot of those facilities are back to operating with their employees back in the office. So a bit of good news there. So hopefully that all calms down a bit. And then lastly, on the stainless side, we've talked about this in the last couple of months. This is the price of molybdenum. We talked about its parabolic rise higher. Again, kind of just on this notion that demand is outpacing supply. There hasn't really been much more specific news on the molybdenum market besides that. But I will say, since basically early June, we've seen this market plateau out. So I don't know if the worst is behind us, but we obviously saw a parabolic move higher, and we started to calm down at these higher levels. So for those who buy 316 stainless, again, this likely leads to higher 316 stainless surcharges as we sit here at 1830. If we were around 6 months ago, we would have been closer to 10 or 11 bucks a pound. So pretty swift move there. That is all I've got on the commodity update. I am happy to take questions if there are any.
Yeah, we have some here queued up. I hate to jump the line, but I have one coming off of this. You look at steel and aluminum and stainless, and they're kind of all in the same boat, if you will, right? In terms of higher prices, tighter availability.
Sure.
When one comes back, does it generally kind of bring the other two back, or right? Do they all have a kind of an interrelation there, right? Like if you see steel start to ease, can we expect stainless and aluminum to follow the vice versa?
From a very, very high level, I would say fundamentally that would make sense. It would make sense that if the demand for industrial goods is all moving in one direction, either to the upside or to the downside, generally speaking, yeah, it would be consuming similar relative amounts of copper or stainless or aluminum or zinc or lead or whatever it may be. So I would say, generally speaking, fundamentally, yeah, that would make sense. I do think there are some small intricacies, and this is where I kind of geek out on commodities. I do think there are some intricacies where you can get into the woods and start to talk about what makes each individual market different. And that's where I think these markets get fun to navigate and very interesting to navigate and talk about, because we talk about this notion that within the carbon steel industry, the dynamic has changed. At least within North America, the fundamental landscape of the carbon market in the US has changed this year versus 3 years ago. There are fewer players. There's a lot of capacity that's been taken offline, a lot of that on a permanent basis. There is, admittedly, on the flip side, a lot of new capacity that's coming online in Q4 and in 2022 and beyond that. But those types of evolutions will and can cause some markets to deviate from others. So for instance, could we possibly see base metals all move lower from here and roll over a cliff because China's going back into lockdown, but yet carbon steel prices remain elevated? Absolutely, that's possible. I mean, that's actually it's certainly a potential that could happen. And I would actually make the argument that base metals tend to be a little bit more of a global commodity. They trade on the London Metal Exchange. They tend to be very cognizant of what's going on in China and Europe and the US. Whereas US steel prices, they care about imports, they care about what's going on in China. But for the most part, it's, hey, where can I get my next ton of steel from the US mill? And that's the predominant source of where they get their metal. So there's a greater regional reliance in the carbon markets than there is in base metals. So it's a very long-winded way of saying, yeah, they can deviate at times.
It definitely makes sense. And I think one of the questions from the audience plays off that too. And they were definitely paying attention last month because they want to know, how's Dr. Copper doing these days? Where do we see copper markets going?
Yeah, sure. Well, I can't give you a color on where it's going because I don't know. I can tell you that over the last month or two, it has gone mostly sideways. So it's not at record high prices anymore. As we sit here today, we've got copper here at $4.27. That compares to a record high price of about $4.55. So we're off 6, 7, 8% from the highs. I do think copper is going to take a lot of cues. Again, copper is a base metal. It tends to be more of a global type macroeconomic indicator. I don't think this is too big of a stretch to say if we see China go back into full-scale lockdowns or we see Europe go into full-scale lockdowns, I mean, those types of things absolutely will have an impact on demand. I don't think that's any stretch to say that. So copper is certainly keeping its eyes on developments with regards to that. And I think that probably explains some of the reasons why we've seen a little bit of a pullback. Now, if that then spreads more to the Western Hemisphere, we see issues here. Yeah, that would probably continue that. But again, do I think it's going there? I'm not here to predict how politically we're going to handle lockdowns or not lockdowns or how a virus is going to spread. I've tried to play that game and I just get yelled at by all my friends.
So you touched on back to capacity. We had a question here, with delays in new capacity coming online and 232 tariffs potentially not coming off anytime soon.
Great question.
Oh, I'm sorry.
Yeah, no, it's a great question. I apologize that I didn't bring that up earlier. That had to come from a question. But just in the last couple of days, there has been speculation that, and they even gave a date that as of November, we could see a resolution on Section 232 with regards to Europe. The question then becomes, if we believe that, if it does happen, does it matter? A lot of the prognosticators are kind of saying they don't think it'll have that much of an impact for a couple of reasons. One is Europe's running fairly strong right now. They aren't exporting a ton of aluminum. They aren't exporting a ton of steel yet. That could change. I do think, and this is in the very early innings, but I alluded to this fact that John Packard, who knows the industry well, he mentioned that we're starting to see competitive import offers. Those were specifically, I mentioned Turkey, but there's no reason to say that if Europe were to go into a slowdown and they see the US as the best bastion to send some of their excess steel, that could certainly happen. If 232 is not there, well, that takes 25% out of the price for steel and 10% out of the price for aluminum. So it may not matter yet, but if 232 goes away and Europe weakens up a little bit, it could matter. Yeah, I mean, anytime you're taking tariffs away, it's got the potential to open up the import landscape a little bit more, which would help to normalize domestic North American supply demand conditions.
Absolutely. We're getting a flood here. One of the questions is,
it's everybody mad at me for talking about COVID.
Well, Dr. Doom, they want to hear from Dr. Doom. if you go back to, I believe it was in your carbon section here, it's kind of that, the question is what's driving the stair-step climb of US HRC versus China and EU? We've seen that stair-step, and I guess what's the reason?
Yeah, so I do have to admit a little bit of guilt, or we can call it laziness. Here within this chart, this is not the actual index. So you can pick your index, CRU, TSI, Platts, whatever you want to pick. This is not the index data points being shown here. You can see it up in the top left. HRC1 is actually the rolling front month futures contract for hot rolled coil steel. And that's a very mouthful way of saying every time a futures contract expires, it then has to reference the next month's futures contract. And every time it does that, at least over the last 12 months, it's had to reset higher at the new futures contract, which just happens to be higher than the previous months. So I think what they're asking is, why do you see it jolt up and then go sideways? In reality, if we had a CRU index here, it would look smoother. It would look a little more like the European data, and it would be a little more straight line. So I apologize for being lazy and using the front month futures contract. But I will say, generally speaking, the front month futures contract settles against the CRU. So there tends to be a very high correlation between the two.
You're anything but lazy, Nick. You're the hardest working man in risk management. Don't let anybody tell you differently. There are two industry related questions here, I think play off well. How does the auto market and the chip shortage affect this potential drop? You've talked about that often. And then will aluminum increase the price of beverages, beer, pop, et cetera, and are contracts in place for food and beverage industry to absorb? So I say they're kind of related, right? Because how are the industries kind of absorbing these?
Yeah, sure. I'll focus on the steel side. Well, I guess it wasn't specifically on steel. It was mainly just on auto in general, which kind of impacts all metals. Yeah, I mean, we've talked about it in the past, and I guess, are there any updates? Ford, GM, Chrysler, the big guys have announced public earnings at this point, and the best data I can give you is what they've told us, which is they don't yet see the semiconductor issue abating. It sounds like it's most heavily impacting Ford versus the others, but it is impacting all of them. The anecdotal commentary that I'm getting is that it's at least going to be with us for the balance of 2021 and likely into some of 2022 based on their public commentary. But in terms of actual metals demand, we are not hearing or seeing many anecdotes of supply that would have gone into the automotive sector coming available in the general market. And I think that's happening for a couple of reasons, but the biggest one is, as we understand it, a lot of these automotive contracts were struck kind of right around this time last year. And as we mentioned, or as you can see here in this chart, prices were a whole heck of a lot lower at that point in time than they are now. And for the automotive contracts, they tend to be annual contracts, at least 6-month contracts, but a lot of times they're annual as well. So these automotive companies are likely consuming tons or bringing in tons to their warehouse at way, way lower prices than where we are right now. So I'm not a procurement person for Ford or GM, but they would almost be crazy to turn away those tons because they're advantaged to the market by 300%. So as we understand it, the way a lot of the automotive and Class 8 truck entities are dealing with the semiconductor shortages, they're doing a lot of work in process where they're completing the portions of the car that they can with the materials that are available, in this case, steel, aluminum, stainless steel. They're putting it into the cars, and then as the semiconductors come due, they'll put them in there and ship them out. So I think that's one of the reasons why I think we're still seeing the slowdown with regards to automotive. And I don't have a chart in here on automotive demand, but just high level, if you're looking at, it's the seasonally adjusted auto sales figures, they would have peaked out a couple months ago at like 18.5 million run rate for 2021. That figure's already come down to about 14.5 is the latest data point. So you are seeing a real slowdown in production from the automotive side in terms of completed vehicles, but that doesn't necessarily mean that they aren't consuming steel still, and it doesn't mean that they aren't still making the vehicles just on a work in process basis. They just aren't coming out into the marketplace yet. And then on your second question, is it going to raise the price of beverages? God, I hope not. I hope they don't increase the price of beer. No, I do think this is more of a high level answer, but I do think we're seeing inflation across everything. I think
Mhm.
if you're talking to Miller Coors, you're talking to, I mean, Kellogg just announced earnings this morning, and all of these publicly traded consumer products companies are saying, yeah, robust increases in cost of goods sold. I think it was Whirlpool, which this isn't beverage cans, but it's going to be the same story across all these companies unless they had fixed price contracts. I think Whirlpool said it was going to impact them by $1 to $2 billion just on the metallics side. So,
Yeah,
so
yeah,
yeah, I don't think, these are profit driven companies. I don't think their intent is to absorb those cost increases. I think they come through to us, unfortunately.
exactly. I think that's a broader issue, right? How do you have they absorb those or they pass along, right? I think it applies to any market that you're talking about. Um, Lead times, are we seeing those decreasing at all? Still running very late?
Depends on the market. I mean, I think if we look at stainless, I would say most stainless product managers probably say not much movement. I would say similar on the aluminum side, not much movement. On the carbon side, you might say generally not much movement. I think there are some very small indications that backlogs are coming due. I think if you look at MSCI data across service centers, inventories are coming up at a faster clip than shipments are going up. So it does look like there's like the catch up game is taking place. So whether or not that's actually reflected in if you place an order today, when do you get your shipment? But I think generally speaking, is supply becoming more available? I would say in the carbon side, it's in the early stages of that happening. Yeah.
We got a nice follow-up question from the automotive answer you gave, which I think is really, really interesting here, right? If the automotive industry is bringing in the inventory, yet not consuming it, do you think that's impacting realistic demand and supply cycles going forward?
It could go one way or the other. And this is a very difficult thing to answer because I don't know how it plays out, but I'm sure anybody who's been by an auto dealership parking lot can see that they're pretty much empty. You look at the inflation numbers, one of the biggest drivers of inflation has been the used car market up to this point. Now, I think other things are also going to inflate wages, things, rents, things like that. But up to this point, used car markets have been a big headline driver over the last couple of months. And, I think there is a question of if they've been bringing the metal in up to this point, will it have any real net impact on steel demand? You could argue that it'll have less of an incremental impact on steel demand when they finally start getting their semiconductors, because they've been kind of doing business as usual anyways. What it could impact is the finished auto market, because all of a sudden you start to better supply the market with finished product. On the backside of that, could there be an argument that if cars finally become more and more available, maybe used car markets start to come down, and then people have an appetite to buy cars again? Do they actually ramp up production? That could play out, but that's a couple different steps of what ifs that I don't know yet. But I guess generally speaking, it doesn't seem like the steel industry is reeling very much from the fact that finished automotive production up to this point has fallen off fairly significantly.
Gotcha. Okay. Just a few more here. We've got a limited time left. Speaking specifically to stainless, how does stainless production compare now to pre-COVID levels?
So I will answer the question first by saying, in terms of production numbers, I admittedly don't know the answer to that. I will try and find out the answer to that. But I just had a call with some of our supply chain team, and the high level anecdote is stainless steel mills are kind of in the driver's seat with regards to what products they want to produce, which ones are going to be more profitable for them. And again, this is my first answer is I don't know, because I don't have the same data around the actual production numbers the way I do with carbon steel. But there's absolutely the case to be made that stainless steel mills are picking and choosing where they want to fill production processes. What I mean by that is, if they're looking at a certain grade of stainless, the 400 series of stainless that requires more argon gas or requires more heating components, or it takes longer to make, there's a chance they may say, well, we'll just produce less of it. And what's that going to do? It's going to tighten up that specific grade of market, and probably force people like us, or force our consumers to seek elsewhere, either other domestic mills or foreign sources. So that's not a perfect answer to the question, but I will say stainless mills, because they're seeing lead times so extended, and they really, it is a seller's market. They are very much so, I don't want to call it a game, but they are very much so pulling the strings to produce what's most profitable for them, which makes sense for publicly traded companies.
Makes sense. Two more here. So this one talks specifically on hedging. Can you touch on who benefits from hedging purchases, even though it's a minority percentage of cost that you are locking up? There seems to be too many variables.
Benefits from hedging. This is coming straight from Nick Webb, who's in charge of hedging. No, I mean, it depends on the scenario. If, as we sit here today, we've got record high steel prices. Would it make sense for a consumer to hedge in today? Maybe. If steel prices keep going higher and higher, a customer might be very happy that they lock in today. And admittedly, we've got a lot of customers who, even given spot numbers around 1870, we've still got a lot of customers who are locking up carbon steel for next year. We've got a lot of customers who are locking up aluminum, and we have a lot of customers who are locking up stainless right now. I tend to take the belief, and this is a little bit of a commercial, and I apologize, but there are a number of different reasons why customers would hedge. And I would say first and foremost should be, if you as a consumer of product can get a grasp on where you're pricing or how you're pricing your finished product out the door, and you haven't yet figured out a way to price out the product that's coming in the door, i.e. your metal, then you've got a mismatch. And to the extent you've got a mismatch, you should either be, one, okay with taking that risk, and you're basically hoping that prices come down, or two, you should probably manage that risk. And you can manage that risk by stockpiling metal, hedging it, doing whatever. Some customers have a very high luxury of being able to pass through cost increases. Some don't. For those who don't, I would say hedging is an advantage for them. It's a value add service. It's not for everybody, but on the flip side, who can benefit when we're at record high prices? Well, if you're a steel mill and you love the fact that steel prices for the next 18 months on futures, which they are above $1,000. And if you're a steel mill and you can make profits above $1,000, which I would say every steel mill in the world can make money above $1,000, maybe they want to hedge the downside risk, and they actually want to short futures and protect themselves from a correction in prices. That would be a way that the other side can benefit too. So, there are ways to do hedging wrong. There are ways to have it not work for you. But as long as you're doing it with the right perspective, I think it can absolutely be a beneficial thing.
Absolutely. Yep.
Thanks for teeing up the hedging workshop.
Yeah. Well put. So let's end with this one, and I think it might even usually kick it over to you for your closing thoughts, but I think this tees up your closing thoughts well. But before I say that, let me say this: that thank you everybody for joining. This is always very insightful for me, insightful hopefully for everyone that attends. A full recap will be posted next week on Ryerson.com. The video short snippets. Also join us every month. It's the first Thursday of every month. But Nick, this is a great question here from the audience. If you were to look into your crystal ball, what helps us get back to more stable metal prices, and when does that happen?
I mean, we've talked about this in the past, and I hate to answer the question with the elephant in the room, but it's, if you can tell me when we get back into normalized employment conditions, not just within North America, but on a global basis, and we can get our hands around getting comfortable with the virus that is spreading around the world, you can answer that question, in my opinion, because I think supply chains continue to be disrupted, maybe less so in certain countries. We kind of talked about the flatbed market versus the containerized freight market. I think there are regions that are dealing with it in different ways. And anytime you've got less cohesion in these global supply chains, you've got bottlenecks. And so, yeah, in terms of my crystal ball, it's lasting far longer than I thought it would, far longer than I hoped it would. There's been a lot of surprises along the way over the last 12 months, but I think that's the best, honest, high-level answer I can give. I mean, anecdotal, but we're finally creeping back into the office on a hybrid basis. I think that's helpful. I think a lot of our customers have probably been working in the manufacturing space maybe for the entirety of the time. A lot of our customers were deemed essential and didn't really have any time off. But some countries didn't approach it that way. Some countries did have shutdowns, slowdowns, and still are having shutdowns and slowdowns. So unfortunately, we're not through it. But that's the $1 trillion question. If you can figure out that answer, you know the future better than I do. And so I apologize for not having a better answer for you on that one. But I do, in terms of parting remarks, we're getting back in normalized conditions where I'm able to travel, our salespeople are able to travel. Hopefully, we're able to take advantage of meeting in person, face to face, one of these days here soon, either at a conference or at your facility. And I look forward to those days. And I do look forward to a little bit of more normalcy, a little bit. But along the way, we're going to see choppiness. We're going to see bottlenecks. I think we're going to see a lot of volatility. And that's going to make my job really fun because I'm in charge of risk management and watching these things. But it's going to create some difficulties along the way. There's no doubt about that.
And based on that, Nick, I want you to back up to your first slide on the chart for me.
All right. Your slide, your metals perspective?
Nope. Keep going.
This one?
One more.
I'm on the Cup of Joe slide.
You got your safe harbor statement up?
Oh,
there you go. I don't think we hit on that in the beginning.
I have to say, none of this is investment advice. Do your own research. Don't take trading advice from Nick Webb because he may very well be wrong. I kid, but we have to disclose this. We hope that you find the information valuable, but use it in conjunction with all the research that's out there in the world. And that's about it. Thanks for reminding me of the legal aspect. I'm sure Mark Silver is very happy with us right now.
Gotta make sure that's in. Thank you everyone for joining, and we'll have a cup of Joe with you next month.
Thank you, everyone.